Positions and leverage are fundamental concepts in finance because they determine how investors gain exposure to financial assets and amplify potential returns or losses. The program explains that a position refers to an investor's economic exposure to a financial asset, market, or risk factor. Investors may hold long positions, which benefit from rising asset prices, or short positions, which benefit from falling asset prices. Leverage involves using borrowed funds or financial instruments to increase exposure beyond the investor's initial capital investment. Understanding positions and leverage is essential because these concepts significantly influence portfolio risk, return potential, liquidity needs, and the overall behavior of financial markets during changing economic conditions. A long position represents ownership or economic exposure that gains value when asset prices increase. Investors holding stocks, bonds, commodities, or derivatives expecting price appreciation are considered long. In contrast, a short position involves selling borrowed securities or using derivatives to profit from price declines. Short sellers eventually must repurchase and return the borrowed securities, creating potentially unlimited loss exposure if prices rise significantly. The program emphasizes that both long and short positions are widely used in investment management, trading strategies, and risk hedging. Analysts must understand how these positions affect portfolio performance, market exposure, and risk management because different market conditions may favor different positioning strategies. Leverage magnifies both gains and losses by increasing market exposure relative to invested capital. Investors may create leverage through borrowing, margin trading, derivatives, or structured financial products. For example, purchasing securities on margin allows investors to control larger positions using borrowed funds, increasing potential returns if prices rise. However, leverage also increases risk because losses are amplified when asset prices move unfavorably. The program explains that leverage raises both expected returns and expected volatility. Highly leveraged positions may also create liquidity pressure because investors may face margin calls requiring additional capital. Analysts therefore evaluate leverage carefully when assessing investment risk, financial stability, and portfolio sustainability under adverse market conditions. Derivative instruments such as futures, options, and swaps frequently create leveraged exposure because they require relatively small initial investments compared with the value of the underlying asset. Futures contracts, for example, allow investors to control large asset positions using margin deposits that represent only a fraction of total contract value. This embedded leverage increases sensitivity to price movements and can generate substantial gains or losses over short periods. The program notes that leverage is a key reason derivatives are widely used for both speculation and risk management. Analysts must understand how derivative leverage affects portfolio exposure, volatility, and counterparty risk because small market movements may have disproportionately large financial consequences. Leverage also plays an important role in corporate finance and financial institutions. Companies use debt financing to increase potential returns on equity, while banks and investment firms operate with significant leverage as part of their business models. Financial leverage can improve profitability when asset returns exceed borrowing costs, but excessive leverage increases default risk and financial vulnerability during economic downturns. The global financial crisis demonstrated how excessive leverage within financial institutions and investment markets can amplify systemic risk and market instability. Analysts therefore monitor leverage ratios, debt obligations, liquidity conditions, and financing structures carefully when evaluating corporate solvency, investment risk, and the resilience of financial systems. Understanding positions and leverage is essential for effective portfolio management, risk analysis, and financial decision-making. Investors use leverage strategically to enhance returns, hedge exposures, or implement sophisticated trading strategies, but leverage also increases uncertainty and downside risk. The program emphasizes that successful investment analysis requires evaluating both the magnitude of exposure and the sources of leverage within portfolios and financial institutions. Analysts integrate leverage analysis with broader assessments of liquidity, volatility, and market conditions to determine whether risk levels are appropriate and sustainable. A strong understanding of positions and leverage enables finance professionals to evaluate investment strategies more effectively, manage financial risk responsibly, and make more informed decisions in increasingly complex global financial markets.